The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Well done, everyone. You get a gold star for making it to the middle of the week. It's Wednesday. Welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho, and these are your headlines. Well, was it inevitable? We might think so. Chinese stocks coming back down to earth a little bit, of course, ending that blistering 10-session winning streak as the reality of the economic challenge sets in. Huge news out of the US. The Department of Justice considering a breakup of Google as a potential antitrust solution. Now, this can take a long time, everybody. There's no rush on this one, but it's after August's landmark monopoly ruling.
France's 2-week-old government survives a vote of no confidence as Prime Minister Michel Barnier prepares to present his budget plans to cabinet tomorrow. And Florida braces for the arrival of Hurricane Milton as officials upgraded to a Category 5 storm, and President Biden warns that evacuation is a matter of life and death.
At the start of a lesson when you were in studying, of course, I'm sure many of you still are with your MBAs and all your wonderful degrees, but when you have a start of a lesson when the teacher straight away gives you homework, so you've got to get through the lesson and then you got homework. Well, I'm giving you all homework here. Then go on to CNBC.com. Other sites are available, unlike with Google browsers. I'm joking. Go on to CNBC.com and have a look at the Shanghai Composite over the last, let's say, 3 weeks. There you go. That's not the hardest homework as well. And when you look at the decline we've had over the last session and a half, you'll see it pales into insignificance. I just want to give you that as your backdrop for everything we're about to say on the show today as well. Good morning, how are you?
Good morning. Well, like a lot of brain work, this is a hungry beast that needs feeding.
Oh, yes.
And the reality is the Chinese markets. The reality is, not you, the Chinese markets.
Shame, I'm normally hungry.
It needs fresh meat, and that's what it's calling for. It's had a lot of movement on the back of what it hoped would be some stimulus measures. It got a little bit of movement on some of the initial measures, but there was no flesh on the bones detail in this economic press conference this week. And the market is now fading the story, waiting for some further news flow here. And if it doesn't get it, what does it mean in terms of the extent of this rally we've had? Will we see some sort of flop back?
By the way, I've just had the Vegan Society on the phone. They say it's rather than flesh meat and flesh on the bones, they want to hear fresh tofu or nut roast. Just checking it out there. Sam Vadas joins us now with plenty more. Sam, this is exactly what you and I and Karen have been talking about for a very long time. In fact, throughout the whole rally. Yes, it's very exciting, these measures proposed, but it's going to take a very long time. A, as Karen says, to put the flesh on the bones, and B, to see whether it's actually working.
Yeah, absolutely. Nothing has really changed since before the holidays. Yes, we had that NDRC briefing, but with the MOF absent from that, we were never going to get a number on that fiscal spending. So really, the stock market has been rallying on the intent and the signals that we got before the holiday about the monetary and fiscal policy coordination. But they were able to rally even without any substance, meat on the bones, as you and Karen have been suggesting, making me hungry because it is lunchtime over here. But I suppose that's what the markets are getting, is a reality check now that, more needs to be done. More signals need to come from the authorities about just how big this fiscal expansion is actually going to be. And so it seems like the market chatter out there is that the markets have a bit of indigestion at the moment, that, have been sort of gobbling up all these, big lines about all this monetary policy and then all the subsequent cuts that we saw to some of those rates, and then the very unusual Politburo meeting before the holiday. What's interesting is that all those accounts that we talked about yesterday, that the brokerages were busy doing an opening over the break, those individual investors weren't actually able to trade until today. So if you had a bit of FOMO during the holidays, today perhaps it wasn't the day because, as we say, we've got the Shanghai stocks down 5%, so erasing most of the gains we'd seen on the first day back of trade. So some fairly volatile and choppy trade for both the Hong Kong and the mainland markets. We did see actually Hong Kong starting the day on a positive note, but then started to lose some altitude throughout the morning session. Remember, we saw the biggest fall since 2008 in trade yesterday. So what the markets now need to see is some signalling and a little bit more on the specifics from the Ministry of Finance. And so there's expectations now that we'll get some sort of announcement or press conference from that department where maybe they're likely to confirm all these numbers that have been thrown out there, anywhere from 2 to 10 trillion yuan for the government bonds to support that eye-watering local government debt, households with stipends that have been reported for families with multiple children, and also for some of these upgrade and trade-in programs for the consumer. But until we get that, the market chatter is that basically this sort of gyration and volatility we're seeing is going to continue. Arguably, they have some time because anything that the MOF announces as far as the fiscal package is concerned does need to be rubber stamped and signed off by the National People's Congress, the meeting that will be happening at the end of this month. So we're likely to hopefully hear from them throughout the next few weeks or so. So don't rule that out is certainly the message in the market right now. Not a huge surprise what we got yesterday, but I think the view out there is to be patient for now. But you know, as I said, the market's getting a reality check. If you take a look at those Chinese ADRs stateside overnight, I mean, falling the Crane Shares ETF about 9%, the large caps doing the same. There seems to be a sense that there was a bit of rotation out of Chinese names, Chinese exposed names into big cap tech. And then, as I said, we did see some follow through in the session in Asia today. Guys, I'll send things back over to you.
Thank you very much for that, Sam. Don't mention rotation, I've got to say. It's head spinning. If you look at the US markets as well, we're meant to be rotating towards areas the markets left behind. But in session yesterday, we were rotating back to technology names. It was the likes of Nvidia, Salesforce, the big drivers for the major boards, the Dow, the S&P 500, the NASDAQ, all picking up steam, as you can see, and the NASDAQ in particular, as technology stocks were out in front. And I'll give you a dime for every fund manager saying, oh, we're getting some breadth now. We don't like some of these technology names. We're looking elsewhere, that we're worried about the valuations. But I've got to say, yesterday, it was all about technology. And speaking of rotation, energy stocks that have been one of the front runners in recent sessions was actually the laggard in session yesterday, breaking a 7-day winning streak and then some, down 2.6%. So fairly decent pullback is what we saw in those energy stocks. In terms of treasuries, let's just take a look. A lot of data still for this week, and the market at this point still just shy of the 4% handle at the 2-year with 3.95%. Fair to say we're still talking about Goldilocks and what sort of landing we're getting for the US economy, and whether that labour market figure we saw the other week is relevant for the Fed as the market steps away from a 50 basis point rate reduction as its next call back to 25 basis points in a series of those sort of reductions. To WTI and Brent, now the trade, the geopolitics still incredibly front and centre for a lot of investors, but this trade, as you can see, morning session is now trying to pick up a little bit more movement to the upside. It's been something where investors have been watching very closely over the past week, and we've now got a movement, another 0.9% on the Brent price, taking us again close to that 78 handle. Gold prices have been consolidating since the record high we saw late last month, so we've got another drift morning session around the 2,600 mark. US futures, to round out the picture for you, what we're expecting later on today, it is a small range, isn't it? But downbeat is the tone. So a little bit of give back from that green we saw yesterday.
Karen, long before your time, but there was such thing as called VHS knockoff in the early 80s, where someone had got hold of a video of a new movie and it was on VHS, but it was so blooming awful because what you had is the picture and the words were out of sync. Carsten Junius joins us now, chief economist at J. Safra Sarasin. I can't help think the world economy, Carsten, is like one of those old movies that's out of sync. The words and the pictures aren't moving at the same line. Let me give you an example of what I mean. You've got China trying to throw the kitchen sink at the economy at the moment. You've got the US cutting rates fairly aggressively but doesn't know if it should be. You've got the Europeans perhaps not cutting as aggressive as they should do because we're flatlining the economy. And you've got the Japanese who are hiking but really don't want to. Carsten, we're all over the place, sir.
Well, good morning, Steve. Good morning, Karen. Well, absolutely, that is the case. Well, maybe we got too used to synchronized upswing and downswing during the pandemic, and now we are back to a reality where different continents face different economic conditions, and that's with the fact that markets now have to deal with.
So with that as a backdrop, does it make it more difficult for our viewers to find ports in storm plus good opportunities to actually make money rather than just save their assets? Or actually, is it actually a really exciting opportunity because the correlation has broken down?
Well, I guess for investors, it's always good if correlations are breaking down. If we find opportunities here, if we shun some assets over there. But we just heard the things about China. It is difficult to stimulate an economy if you're the only one. So. It's much easier if everyone's stimulating at the same time, if everyone is constraining the economy at the same time. Now we have still an oversupply of housing in China, for example. We have a lack of housing in the US and in large parts of Europe. So it's now national policymakers that should make up their mind and decide on what they should do. And here I clearly think we need more policy easing in the euro area. We probably need a little bit less than we just thought a couple of weeks in the US. And let's see what we get.
Carsten, help us out with the US, because the market had that strong non-farm payrolls figure, but they were not that disappointed that some of the rate cuts were taken off the table, because it gave the impression that the US economy is not spiraling out of control, that in fact we still have potential for a soft landing here. What are you seeing when it comes to corporate profits? Because we know the labour force is cooling. What happens next from here on the scenario of the corporate profitability and whether hiring will stay intact?
Well, see, I believe that so far the US economy is pretty strong. Just yesterday, the Atlanta Fed revised up their now estimates for the third quarter from 2.5 to 3.2% for the third quarter. So I wouldn't be surprised if the earnings season that we are actually getting from this week on for the third quarter will surprise again after having surprised for so many quarters in the past. I would also be quite optimistic seeing that corporate margins are actually pretty elevated. And that is a good sign for the overall economy, as it signals, or usually in the past, it did signal that large-scale layoffs are not to be expected that soon. And I think the time frame is extremely important here. We know from declining vacancy rates, for example, from somewhat deteriorating consumer confidence, that the economy is heading for a landing. Whether soft or hard, we always know later. But it's crucial. The speed of that landing is crucial, because now we also are getting some headwind from the tailwind from the Fed that told us that they are ready to lower rates. So here we have a slightly slowing economy, and some support from the Fed going forward. And I believe the combination of those things will be moderation of profit margins in the future, but not at a speed that is causing many problems for financial markets.
Carsten, so some stability from that US picture, but what's the relevance of China here? Because we're getting another flash on the wires this morning from the SCIO saying the finance ministry to hold a press conference on fiscal policy, economic development on October the 12th, so on Saturday. So we are going to get some fresh information after the disappointment around the latest press conference. How relevant is China in the mix? Because it felt as though we did see some relevance with the China markets lifted, but also European markets went with them on that journey to an extent. So how relevant is some strength coming out of China?
Well, first, let me say for investors in Chinese equities, it's absolutely relevant and important that they are making credible announcements and injecting a lot of money in the economy, that they are addressing the imbalance that we still have, the oversupply that we still have in the Chinese housing markets. With another disappointment, I think China could risk becoming even more uninvestable, as some investors felt it should be already before last week's announcement. So that is crucial. Whether any support that we are getting in China is enough to revive the European economy, well, that is something I'm not so sure about. I believe their stimulus should be geared towards, the domestic economy, as I said, the housing market. It should revive domestic demand. But in Europe, the goods that we used to export to China often were investment goods, and whether they are bought at large scale, I doubt. So that's another factor why I'm pretty pessimistic on the euro area economy these days.
Yeah, Carsten, let me add a dose of optimism to the euro area. Come on, if Europe does what it should do and has a proper look without worrying about national borders, has a proper look at the Draghi and Letta reports, then Europe's got a chance, hasn't it? What hope have you got that we actually make some meaningful structural adjustments to the European economy rather than just relying on monetary support from the ECB?
Well, see, we know the problems that we have for decades, and not much is happening. Now, we also see that a couple of countries, namely France and Italy, they need to save a bit more in order to fulfill the budget rules from Brussels. That report that we have from Draghi is addressing all these right questions. But in practice, do I see a political consensus that large-scale public money is spent in such a time frame? Well, no, it simply doesn't exist. And I think we should also not always think about the financing of these projects. In the end, national governments could do this or address these problems even without financing from Brussels. We should have a reform of the debt brake in Germany, for example, that would free up large amounts of money. Well, the fiscal spending capacities, looking from a debt to GDP point of view, are there in Germany. It's just self-constraining itself through this overly ambitious debt brake that they have. So I believe countries could do a lot by themselves without actually going to Brussels. And Draghi addressed the right issues.
Carsten, thank you very much for joining us. Carsten Junius, Chief Economist at J. Safra Saracen SAM with us. Let's talk about some of the big central banks. As India's central bank kept rates unchanged as expected and shifted its stance to neutral in its latest rate decision, which could open the door to cuts. India's rupee is steady in the wake of the decision. Meantime, I've got to say, a big difference between Australia and New Zealand when it comes to monetary policy at this stage. A fairly massive Tasman Sea between the two, as the New Zealand dollar is now extending declines against the greenback after the country's central bank slashed rates by 50 basis points and raised the prospect of further cuts after it said policy is still restrictive. The move was in line with market expectations and puts the country's cash rate at 4.75%. That said, don't forget the market was caught by surprise with that first interest rate cut in August, so they quickly had to scramble to come up with the rest of their expectations. So that is fairly large moves in a small amount of time. The Aussies, by comparison, Steve, have been on hold for about a year.
Extraordinary, isn't it? Yeah. How can the New Zealanders be in, according to the RBNZ, in excess capacity, but the Australians aren't? Similar markets, similar export markets, similar problems with one of the biggest importers of egg goods, China. Anyway, coming up on this show, Barnier. Hang on, he's been Prime Minister a week or so, hasn't he? He's now survived a no confidence vote in France. Phew. Ahead of a hotly anticipated budget that's due tomorrow. We'll be joined by Charlotte with the latest next. Plus, we're counting down to earnings out of the big US banks on Friday. Find out what to expect as earnings season gets into gear. Let's hope it's not reverse later this hour. And as crude prices slide, we'll get a reading on the energy sector with Remy Eriksson, the CEO of DNV. That's coming up in 11 minutes' time.
Interesting story unfolding around Gucci. It has all changed once again that Gucci's Kering has chosen Stefano Cantino as the struggling label's next CEO. The news comes just 15 months after Jean-Francois Pallas took on the role. Cantino, who is currently Google's deputy CEO, will take the reins in January. He does hail originally from Louis Vuitton as the head of communications and image and had 20 years at Prada, so somewhat of an industry insider.
Because you're worried. You've been worried for days that they're up in the price point, but they're not Louis Vuitton.
Oh, you do listen to me.
I listen to... Hang on. I'm not at home now, am I? Listening to my other Karen in my life. I have two. Yeah, I do listen. Yes, you've been saying for a long time. That your observation, and I take you on board of this because I don't go into too many Gucci shops, is that they've upped the price point, but they haven't got the LVMH, I don't know, kind of... it's
cachet.
Not quite... Cachet, that's exactly the word, yes. It used to be an old aftershave, I think, cachet, didn't it? Anyway, and so, ergo, having this gentleman on board, maybe that's going to increase that cachet.
Well, given the background, communications and image, it's about optics, isn't it? So they are very much going after the quiet luxury element of the market. But as I said, there's a very high price tag. And let's see whether that catches on, because what Gucci did so well and that created that Gucci moment was becoming so fashionable, you couldn't not want to buy it. And the Chinese customer lapped it up in spades. So let's just see whether this is going to be another change of direction for the company. Others are doing, I've got to say, what Kering was doing, or what Gucci was doing. Valentino, for instance, that's picked up the former creative over at Gucci. A very similar approach now. Valentino's having a moment. So there are other rivals in the space.
It's like... So you had me, you do this. So it's like being at home. You're listening, but you're not hearing, aren't you, Stephen?
I thought you
Have you been talking to my wife? Have you been talking to my wife? No.
I haven't, but it's a big trade in Europe. Don't forget, these are
men
key...
listening but not hearing.
These are key stocks in the granola basket. They have been big movers and drifted off the lows, so there's been a real trading pattern around these names. So I think getting up close with these names is quite key at this stage. Let's push on to the other end of town. We'll see whether we can banter about this one. There's the fast fashion giant Shein's UK sales hit $2 billion in 2023. That is up 38% from figures it reported for the 16 months to the end of 2022. Shein, which is waiting for regulatory approval for a potential London listing, doubled its UK pre-tax profit last year compared to the 16-month period. Arguably that would be a negative sign, you'd think, for retail in the UK, because it suggests that you're seeing a lot of trading down by some customers. But I think there are a lot of different stores having a moment. Next, M&S still managing to hold the line.
What is Shein valued at? Is it the numbers? Again, like all these IPOs, it's hugely differential. Is it $66 billion? Is it $100 billion? I've seen them both as well. And again, they are making profit, and that's great. But let's just recap on what you just said. UK sales hit $2 billion in 2023. What I really need to know is the global sales in order to make a decent price to EV to sales valuation model.
Well, margins are wafer thin. However, it is growing its market share and is growing its sales volume in a lot of markets. So whether it can grow into its PE would be something that the analysts are looking at the stock for the listing would be trying to assess.
Was, I've got from the 21st of this month, estimated $32 billion in 2023. So actually the valuation doesn't look unbelievably extraordinary.
Thank you for listening to Squawk Box Europe Express.
For more market moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.